So all in, if you think about the last decade or two, we went from an age of abundance, cheap money, low interest rates, cheap labor, not much wage growth, cheap commodities have been sideways for a decade. We think we're moving structurally into an age of scarcity. Money costs something again, commodity is going to cost something again, and wage growth is higher. In that environment, there's more competition for resources, competition for labor, and that pushes prices higher. It also means governments become more interfering, they intervene more by trying to put industrial policy in place, like building a chip plant in Arizona, for example, and that can crowd out the private sector as they start to dictate where money goes. So long story short, again, not 1970s, but we're starting the pendulum back the other way, away from maximum disinflation towards slightly higher inflation going forward. So why does that matter? Here I'm showing the rolling 5-year correlation of US equities and US bonds. Everyone thinks equities and bonds are negatively correlated. Here's 120 years that says otherwise. Most people are used to that shaded area down there where they're very negatively correlated. Again, equities and bonds offset each other, smooth your return profile out. Every other period has either been, at best, oscillating around zero or structurally positive. That is a different environment for most investors because most people have been investing in that period where equities and bonds offset each other. So that means you have to look at your asset allocation. From a structural allocation, that means, what do I put in that bond bucket? Is it just government bonds? Do I look at credits, inflation-linked bonds, et cetera? Or how much equities do I want to hold if I can't hedge it very well using fixed income? The whole structure of your strategic asset allocation has to change if you have higher interest rates and higher equity bond correlation. If you're more tactical, that means there's more opportunities to take advantage of moving asset prices. And I'll get to that on the next slide. Because we have inflation, because we're seeing equities and bonds become more correlated, people aren't really sure what kind of environment we're in. When you had no inflation, all you had to worry about was growth. Growth is positive, great. Growth is negative, recession. When inflation's moving around too, it's trying to figure out which way they're going to find out where real GDP is. And that's far harder to get your head around. That's why the market narrative keeps shifting every quarter almost. You might recall we were in a hard landing in 2023, then it was a soft landing, then it was higher for longer, then a soft landing again, then it was higher for longer again, but it doesn't matter because growth is higher. Then went to stagflation, and now we're talking about hard landing again because growth is falling off. This change in narrative shouldn't be happening every other month. But because investors aren't used to this volatility, they're not used to this positive equity bond correlation, it's making the old signals to watch a bit more complicated. Just bring yourself back a year ago. Here we have the green line. This is consensus GDP forecasts for the US equity market, US economy. The blue line is inflation expectations. You can see the green line went down to 0.5. That was when everyone was talking about, is it going to be a soft landing, stays above zero, or a hard landing, drops below zero? At the time, you can see our blue dots were our expectations. We thought there was a recession. Obviously, we were wrong. But as you can see, we adjusted our expectations up higher quite quickly ahead of the market. Why? Well, if you think about what happened over the past few years, we had rolling recessions in the US. We had COVID, services crashed, goods did really, really well. We were released from our houses, goods did poorly into recession, services took off. And we're in a situation the last couple of months where services were gangbusters, manufacturing in a recession. The view was hiking interest rates to 5+% in the US would cause demand to fall and make services catch down to manufacturing. Looking at the bottom-up data, though, we saw improvements in the manufacturing sector. So our view at the time was rather than services catching down, manufacturing would catch up to join services in a synchronized recovery. So we got ahead of the pack, increased our equity weight, increased our risk view, upgraded our GDP forecast, and you can see what's happened since. The economy's been very, very strong since then. The question here is, though, if the economy is so strong, how can inflation stay that stable? Inflation expectations remain very, very subdued up there. I mentioned more structurally the reason why I think inflation might be higher. If that starts to increase, volatility will come back, equities will sell off, bonds will sell off. If we can keep expectations flat and growth continues to hold up, that's a very positive environment for equities, probably less positive for bonds because growth is higher. But for us, understanding this regime shift and what's going to happen looking forward is quite important to your tactical asset allocation